I am Albert. I'm the Deputy Country Manager in StashAway Malaysia here, and I'll be your host for today's session. We are joined today by Stephanie, who is our CIO. Hi, Stephanie. How have you been?
Hi, Albert. Of course, a lot of things have happened in the past few weeks, and this market never bores anyone. So I guess it's time
Yes.
for us to update everyone on what's happening again.
Yes, it certainly has. It's been an exciting 1 month since we did our last update, where I guess at the start of February, there was a lot of optimism in the market. And now, I guess a bit less so as things have changed. But before I do go there, let's talk a little bit about the economic data that has come out of the US. Some of you may have been asking, why do we focus a lot on the US? And that's because it's one of the key global drivers of growth, and the US monetary policies itself, they have big implications on the rest of the world, especially given the US dollar dominance. So last week, we saw the Fed's favorite measure of inflation, the core personal consumption expenditure, coming out at 0.6% month on month. And that was above the expectations of the market at 0.4%. So question to you, Stephanie, in addition to this very strong figure, we've been seeing a lot of other strong economic data. We've been talking about it in the last market commentary, where we saw non-farm payrolls, unemployment data, average hourly earnings. They were all above expectations. So is the US economy and also the rest of the world, especially with China reopening, running much stronger than expected?
Yeah, that's a question everybody's asking. And if we rewind a month ago, we were talking about the FOMC meeting, whereby Powell is actually more dovish than the market expected. And he actually slipped the words disinflation into his commentary. And that got the market really excited, which explains why we had a market rally surrounding the last FOMC meeting. Now, Albert, you've said that, the data has actually been turning out stronger, but the market actually didn't like that. So, a few of us may be questioning why, right? Isn't data stronger a positive development for markets? Here, unfortunately, because we are still in a high inflation environment, what the market is fearing, given strong data, is that the Fed will actually stay tighter for longer, or even take interest rate higher. So I guess let's look at what data actually tells us. So I think, Albert, you pointed to PCE, which is the core inflation from the personal consumption core inflation, which is one of the Fed's kind of favorite metric. That metric actually looks at things from a quarterly basis. However, we also have some more updated data coming from, for example, the CPI. And if you look at the CPI, which comes out on a monthly basis, actually it's been trending lower in the past few months. So that actually gives the market some hope that inflation will be coming down. However, given the latest release, the CPI also gets revised upwards or downwards. So, for example, when a U.S. government releases CPI as a preliminary reading, and a few months afterwards, they may actually revise it. What we've seen in the past, a few weeks, is that the CPI number has actually been revised upwards. So number one is not slowing down as quickly as previously thought. And that is, of course, not good news for interest rates, because that means that the Fed may have to raise interest rates more, or even kind of stay higher for longer. Second thing is, if you look at a kind of 3-month average of the inflation data. So, for example, looking at core inflation, which excludes more volatile components like energy and food, the core inflation number is still running at around 4.7% on average in the past 3 months. And that actually hasn't changed that much from the beginning of 2022. So again, it's going higher. It's not going higher, even higher, but it's not coming down either. So I think all in all, it seems to us that inflation may be peaking, but that peaking process is actually quite slow, and maybe a bit slower than what the market has been expecting and what the Fed has been pricing in. So the U.S. concern still remains within like how high interest rates will go and how much inflation you're getting. A key concern that the US voters are voicing right now is also that they think inflation is affecting their ability to spend. So, I think given all this focus, the Fed will have the meeting quite soon, and the market right now is sort of expecting, the Fed to raise interest rates even further.
Yeah, I guess following on from there, right? What's interesting about the Fed meeting is the minutes after the Fed meeting. So one development or one event that came out of last week is that we saw the Fed minutes. That was, it helped confirm that there will be more interest rate hikes. That's obvious. This is from there it was likely to see that it's going to have 25 basis points hikes for the next 3 Fed meetings in March, May, and June. So what came out of there too was that there is an expectation of not only 25 but 50 basis points hikes in terms of interest rates. Markets, as a result, are expecting the terminal Fed rate to be 5.5%. This is versus 5.1%. Of the Fed committee member estimates back in December. So what are the implications of these, higher rates now, right? Because initially we went into the start of the year with expectations of rate cuts at the end of the year, but now that doesn't seem to be the case. What are the implications of such a situation?
Yeah, so I think if you look at the pace of interest rate hikes, it's been very, very quick, right? Basically, over the last 12 months, the Fed has raised interest rates by more than 400 basis points, which is historically very, very fast pace. Now, at the beginning of the year, I guess the market was hoping that the Fed would stop at around 5% and start actually to cut way below 5% towards the end of the year. Now, as Albert correctly pointed out, the market is now pricing in actually 5.5% of terminal interest rate, which is where kind of the Fed will stop hiking. And even at the end of 2023, the market is now expecting interest rates to stay above 5%. So that expectation have shifted quite a lot. Now, this is the market's expectation. Of course, things can change. And what will change that is the data that comes out, because Powell has clearly said at the last meeting as well, and in his commentary, that right now the Fed has become a lot more data dependent of whether they'll take interest rates a lot higher. So then we have to ask ourselves, between now and the next Fed meeting, which is March 20th, what are the important data that will come out? So there's actually 2 pieces of important data. The first one is the employment report, the non-farm payrolls. And the second piece of important information is actually the monthly CPI for February. So we talked about inflation already. It seems to be stickier than previously thought. So then the other piece of the puzzle is actually employment. And if employment shows a very weak labor market, then the Fed can become more dovish, and the market will actually price in smaller rate hikes. But if employment is still very, very strong, then the Fed has no excuse to not hike more, and they may hike 50 basis points. So I think if you look at the non-farm payroll, the last report was very, very strong, right? The market was actually expecting around 300K additional jobs. The final result was actually more than 500,000. So that was a very, very strong report for January. There are some seasonal factors. So for example, typically in January, there are more layoffs in the hospitality sector or leisure sector, because after Christmas, and I guess the holiday demand would not be there. And it's some employers actually take that chance to let people go. So that actually didn't happen in January. Would that happen in February? Possibly. But also, I guess if you look at the other economic data, those have been weakening already. So employment is one of the most lagging economic indicator. What are the more leading ones? We've talked a lot about the PMI. So today is March 2nd, and it's a good time to have this market commentary, because every month at the beginning of the month, we get all these PMI data. And in fact, if we look at the US PMI, it's still very weak. So it's still below 50, although it's not deteriorating much. So given that the PMI is still quite weak, we don't expect, the labor market to actually become very, very strong in the next few months. And particularly if you look at the, the inventory data from the PMI, the kind of intermediary goods are very, very weak. So all in all, I think the January strength may be kind of more one-off, but we'll see. We'll get the number in a week's time.
All right. Thanks, Stephanie. If any of you have questions based on what Stephanie is talking about, please feel free to post them in the Slido link. It's available on the screen as a QR code or the bit.ly link. Alternatively, it's also in the description on the YouTube link. So just feel free to post questions and we will answer them afterwards. So we've been talking about, higher interest rates, economic data coming stronger than expected. How can one's portfolio be positioned for such a situation where things are going very, things are very fluid. The situation is really changing every day on a day-to-day basis.
Yeah, so I think, of course, number one is to watch your risk because the market is very, very volatile. Let's say if you buy at the top and sell at the bottom, it's very easy to get chopped around in this market because the S&P, basically, if you look at the year-to-date performance, it went up by 7-8% in kind of mid-February, and it pretty much gave back half of the gains already. So if you kind of try to do like all these short-term trading of the markets is very, very difficult. But I guess at StashAway, what we do is sort of longer-term asset allocation. What we've identified is in this regime, inflation is still high, it's falling, but growth is also falling. And there's a particular set of allocations that would best suit this regime. In particular, I think if you look at, for example, the allocation that we did in December, we've significantly increased our allocation to short-dated US Treasuries or short-dated kind of safety assets. The reason for that is because, number one, the short-dated Treasuries are now yielding like 4.5% to 5%. So in order for a asset class to be attractive, that asset class needs to return more than that. So, for example, the equities or bonds to become more attractive needs to return more than 4.5% to 5%. So, I mean, that's a very, very high hurdle rate to beat, right? Versus just 12 to 18 months ago, that hurdle rate was close to 0%. So, I mean, we still think that is a safe sector or safe asset to be in, because that also gives you optionality, right? You can actually be in cash-like or cash equivalent, earning that interest rate while kind of taking your time to kind of see when is a good time to redeploy capital into the market. So we think actually that is one good option for investors who are more risk averse. Now, of course, if you are more risk seeking, then I mean there will be opportunity for you to allocate more into risky assets like equities and bonds. And even within equities and bonds, there are different segments, right? In equities, there are more defensive sectors like healthcare or consumer staples, etc., which I mean still has kind of the long-term growth prospects, but are more defensive in nature. So those are the things that we've actually rotated into. I think lastly, if you're more risk-seeking, then I mean, emerging markets or China exposure would be a good one to have. I guess we talked about the PMI, right? So PMI for US is contracting. However, the latest PMI for Asia and China is actually quite encouraging. In China, for example, the PMI figure rose above 52 in February, and that's a very, very strong kind of demand recovery base because of the COVID reopening. Elsewhere in Asia, Thailand, India, etc., I mean, these are also registering pretty strong economic growth. So those are areas that are more attractive on a relative basis.
Yeah. Speaking about, I guess, China itself, we have a question here from the audience. They are asking, would you consider investing in Chinese internet companies because they are significantly undervalued? And would it be worth it given the political risks that we've seen there? Yeah,
I think if you think about China as a whole, it's, of course, a significant portion of that is already in internet companies. given that these companies are very, very big caps, right? Tencent, Alibaba, etc. The second biggest kind of segment is the financials, like the banks, and like the insurance companies, and to a certain extent the real estate companies. And then you have like the industrials, etc. So by investing in broad MSCI China or broad China, there is already quite exposure to the China internet sector. However, of course, like there are, I think, cyclical drivers driving the rise and fall of the internet sector, including, of course, as you mentioned, the political risk. That has, I think, compared to a year ago, probably now that risk have subsided a little bit. But I think structurally there are some changes as well, right? Structurally, for example, some sectors are still being a lot more heavily regulated by the government. Those sectors are not going to be the same sector as they were, or provide the same growth as they did 10 years ago. Internet may be a good example, property as well. And I think the Chinese government, if we're investors in China, we need to ask ourselves, what are the best kind of growth opportunities in the next 10 years? It may not be what we've seen in the past 10 years, but the benefit of investing in a passive index is that it does the auto rebalancing. So, for example, when China internet was actually on the rise, Tencent's weight or Alibaba's weight grew a lot, right? So by investing in a passive index, every day the index actually rebalances it for you. So you actually grow with what's actually the sectors that are growing, and the sectors that are not growing gets rebalanced away. So I think that is a good way to get broad exposure to where growth actually will be. So yeah, to answer that question, I think a broad kind of China exposure makes sense.
All right, thanks, Stephanie. You did touch on earlier about the higher hurdle rate for investing in, I guess, bonds right now, right? Where you can essentially get like a 5% rate on it. So I got a question from the audience here asking, how can one obtain exposure to treasury bills through StashAway?
Yeah, so well, thank you for that question, because then we can we talk about product. We actually launched a product called Flexible Portfolio a few months ago, last year. And on Flexible Portfolio, you can actually choose particular ETFs to invest into. So I think ETFs are a great tool, because nowadays you can invest pretty much into anything using these ETFs. And when we select, for example, on the Flexible Portfolio platform, for each asset class, we've selected the best ETF for you to kind of get exposure into. So if you go into Flexible Portfolio, you can find the short-dated 0 to 3 month US Treasury, and allocate to that asset class. Then the ETF is actually selected for you already. So it makes it very, very simple, very straightforward to invest into these short-dated treasuries.
All right. And I guess in a way too, where we can follow on from flexible portfolios is that there's another question asking, will StashAway be having an emerging markets themed portfolio? Because it seems like we are pretty bullish on that.
Well, I think, thank you for that suggestion. So if there's enough demand, then we can create a template on Flex. Right now we have the emerging markets ETF, which is, and also emerging market bonds. So a good portfolio would be kind of balancing the two. We also have both actually in our ERA portfolios. So by investing in ERA portfolio, you are already kind of invested into emerging markets. We have not taken emerging markets to overweight yet, so we're not like kind of ultra bullish, because still, we need to see more signs of global kind of risky environments stabilizing. But we've taken emerging markets to market weight because we think that relative to the US, you can actually find better returns there.
All right. So, maybe to add on to that too, if you're keen to try out the flexible portfolios, they are free until the end of June. So there is no harm giving them a try. If you want to create a China-specific portfolio, an emerging market-specific portfolio, those are totally doable. There's no more questions for now. So and I think we're slightly past time. So thank you very much, Stephanie. Thank you to our audience for dialing in. And I hope you all have a good night. Again, thank you.
Thank you, Albert, and thank you, everyone. We'll see you again next month.
Thank you. Bye-bye.
Subscribe to our YouTube channel to get notified whenever we have new content out for you. Also, don't forget to download the StashAway app. It's available in the Apple App Store as well as the Google Play Store. So you can start on your financial journey right now.